Hi, we're here with Larry Swedroe. Larry, thanks for being with us. Larry, I've heard you say occasionally that bear markets are like death and taxes. Can you explain that?
Yeah, let's do a little Q&A, Matt, to lead us to the answer to that question. So the first thing I want to ask you is this. Are stocks riskier investments than one-month treasury bills?
Yes.
Yes, they are. Okay, so why do people then invest in stocks if they're riskier?
Well, we want the return.
All right, so you have an expectation of higher returns, right?
Right.
Do you always get that higher return?
Not always.
Not always. Now, if you always got that higher return, would there be any risk in investing in stocks?
No, I don't think that world can exist.
And that's right. That world can't exist because there was no risk. Then stocks would have the same expected return of treasury bills. Now, you wouldn't like that world, would you?
No.
We like the world where stocks earned us about 10% a year when treasury bills earn less than 4%. Okay? Now, the next point that we need to get across is this. We have had some really bad bear markets, this one, of course, being a very painful one, but its drop of roughly 50% was pretty much matched by the same 50% drop in 2000 and 2002. And also from 73, 74. But what if the worst case was that stocks only went down 10%, still went down, but nowhere near as bad as these crises? Would stocks be riskier than treasury bills in that world?
If the floor was negative 10%, yes.
Yeah, they're still riskier, but the risk is a lot less. And so the risk premium would go down. So in other words, instead of stocks returning 10%, because on average we've had a PE of about 15, people would bid up the price of stocks. Maybe they'd have a PE of 30, and they would have returned 5 or 6% instead of 10. You wouldn't like that world either.
No.
Right? We want that high risk premium. So in order to have a high risk premium, we need to have these really bad bear markets. So my next question for you, Matt, is are bear markets then good or bad?
Well, I guess in a sense what you're saying is they're good.
Well, they are good if you're a young investor like yourself, okay, and you can wait out that bear market, and you actually should be cheering because you get a chance to buy low. But if you're an 80-year-old widow, they're bad, and because when you're in the withdrawal phase, right, you can't recover because you've removed that money and spent it. So their answer is it really depends. It depends on what life phase you're in. If you're in the accumulation phase, they're good. In the withdrawal phase, they're bad. And so what do? Well, if you're in the withdrawal phase, you can't take that much risk, and you need to lower your equity allocation. So now let's come to this part about what they have in common with death and taxes. The first thing they have in common with death and taxes is they are painful. We understand how painful it is as investors ourselves. It's no fun looking at your monthly statement from Schwab or Fidelity, and we know that, in fact, we tell people you're better off not looking at it because it's only likely to cause emotions that will cause you to try to do something which will be against your interest. The second thing is that they're inevitable. You know, stocks go down on average about once every 3 years. It's much more than people think. So just like April 15th comes around every year, it's inevitable that we're going to have bear markets. We just can't predict when. The third thing is that they are necessary evils. As we said, they're what create the big risk premium. And the bigger the bear markets are, the bigger the risk premium. And that's a good thing as long as we don't take more risk than we have the ability, willingness, or need to take, because then we'll panic and sell, and then you can't recover.
But let me clarify. You're saying it's a good thing because I, as the investor, have higher expected returns.
That's exactly right, because people say, because stocks are so risky, I'm not willing to invest in them unless the risk premium is big. I'm only going to pay 15 times earnings for these stocks. If I thought they were less risky, then I might pay 30 times earnings, and of course if you pay more for something, the return is lower. So then we get to the last point, what else they have in common with death and taxes, which is sort of my favorite part of this. And it's where an advisor really can add value for their client, is this. Death and taxes transfer assets from one group to another. In the case of death, from the decedents to their heirs. In the case of taxes, from one group to another. Well, bear markets do the same thing. Bear markets transfer assets from those who have no plans and weak stomachs, so they panic and sell, to those who have strong stomachs, who not only don't panic and sell, but they rebalance and get to buy when prices are low. In other words, bear markets are the mechanism by which stocks are returned to their rightful owners.
Well said. Thanks for being with us, Larry.
My pleasure.